investing. Welcome, future moguls and Wall Street wizards, to the most exhilarating roller coaster you'll ever ride, the world of investing. Buckle up, because we're diving deep into the ocean of financial markets, where the words risk and reward are your lifeboat and anchor. Imagine investing as a high-stakes poker game. You've got your chips, money, a table full of players, market participants, and a dealer with a poker face, the market itself. Sometimes, you win big and feel like a genius. Other times, you might feel like you just bought a timeshare on the moon. But fear not. By the end of this article, you'll understand how to navigate the choppy waters of risk and reward, make informed decisions, and maybe even laugh along the way. What is risk in investing? Before you start throwing your hard-earned cash at the latest hot stock tip from your uncle's barber's nephew, let's define what we mean by risk. Risk is the possibility that your investment will not perform as expected. It's the chance that you might lose some or all of your money. Think of it as the financial equivalent of skydiving. There's a thrill, but there's also the potential for a rough landing. These are types of risk. Market risk, the risk that the entire market will decline. It's like being on a sinking ship. It doesn't matter how strong your lifeboat is if the whole vessel is going down. Credit risk, the risk that a company or government will default on its debt. Imagine lending money to a friend who has a history of forgetting their wallet. Liquidity risk, the risk that you won't be able to sell your investment quickly without a significant price reduction. It's like trying to sell ice cream in a snowstorm. Operational risk, the risk of loss due to failed internal processes, people, or systems. Think of it as the financial equivalent of spilling coffee on your laptop right before a big presentation. Interest rate risk, the risk that changes in interest rates will affect your investment. It's like trying to ride a seesaw with someone twice your size. What is reward in investing? Now, let's talk about the fun part. Reward. Reward is the potential return you get from your investment. It's the financial equivalent of hitting the jackpot at a casino without the gaudy lights and free cocktails, though those are a bonus. The types of reward. Capital gains, the profit you make from selling an investment for more than you paid for it. It's like buying a vintage comic book for $5 and selling it for $500. Dividends, regular payments from a company to its shareholders. It's like getting a thank you note with cash inside from a friend who borrowed your lawnmower. Interest income, money earned from bonds or savings accounts. It's like lending money to your reliable friend who always pays you back with a little extra. Rental income, money earned from leasing out property. It's like having a house guest who pays rent and doesn't leave dishes in the sink. The risk-reward trade-off. All right, here's where things get interesting. The relationship between risk and reward is a bit like a dance. The higher the potential reward, the higher the risk you're likely to take on. Conversely, safer investments usually offer lower returns. This is known as the risk-reward trade-off. Imagine you're at an amusement park. The kiddie rides, low risk, might be safe and predictable, but they won't give you the same thrill as the towering roller coaster, high risk. The key is finding a balance that matches your tolerance for stomach-churning drops and loop-de-loops. The risk-reward spectrum: low risk, low reward, government bonds, savings accounts. These are the financial equivalent of a warm cup of cocoa and a cozy blanket. Moderate risk, moderate reward, blue-chip stocks, corporate bonds. Think of these as a brisk hike, challenging but not extreme. High risk, high reward, tech startups, cryptocurrencies. These are the financial equivalent of bungee jumping off a cliff. Assessing your risk tolerance. Before you dive into investing, it's crucial to understand your risk tolerance, how much risk you're comfortable taking on. This isn't just about your financial situation, it's also about your personality and emotions. Conservative investor prefers to avoid risk, likely to invest in bonds, savings accounts, and other low-risk instruments. Think of this person as someone who always carries an umbrella, just in case. Moderate investor, willing to take on some risk for moderate returns. Invests in a mix of stocks and bonds. This person enjoys a good adventure, but still packs a first aid kit. Aggressive investor, willing to take significant risks for the chance of high returns. Invests in high-growth stocks, cryptocurrencies, and startups. This person is bungee jumping with a GoPro. How to determine your risk tolerance? Ask yourself these questions. How much of your investment can you afford to lose? How would you react if your investment value dropped by 20%? What are your financial goals and timelines? Your answers will help you figure out your comfort zone and guide your investment decisions. Diversification. Don't put all your eggs in one basket. Diversification is the secret sauce to managing risk. It's like a balanced diet for your portfolio. By spreading your investments across different asset classes, industries, and geographies, you reduce the impact of any single investment's poor performance. How to diversify. Asset classes. Invest in a mix of stocks, bonds, real estate, and commodities. It's like having a well-rounded meal with proteins, carbs, and veggies. Industries. Invest in different sectors like technology, healthcare, finance, and consumer goods. This way, you're not overly exposed to the ups and downs of one industry. Geographies. Invest in domestic and international markets. This protects you from regional economic downturns. The benefits of diversification. Reduces risk. If one investment tanks, others may perform well, balancing out your overall returns. Stabilizes returns. A diversified portfolio tends to have smoother, more predictable returns over time. Opportunities for growth. Exposure to various markets and sectors can provide more opportunities for growth. Understanding different investment vehicles. Let's take a closer look at the different investment vehicles available and their respective risk-reward profiles. Stocks. Ownership in a company. Potential for high returns, but with significant risk. It's like betting on a horse. If the company performs well, so do you. Bonds. Loans to a company or government. Lower risk and returns compared to stocks. Think of it as lending money to a reliable friend who pays you back with interest. Mutual funds. Pooled investments managed by professionals. Offers diversification, but with management fees. It's like joining a carpool. You share the ride and the cost. ETFs, exchange-traded funds. Similar to mutual funds, but traded like stocks. Provides diversification with the flexibility of stock trading. It's like a buffet. You get a little bit of everything. Real estate, investment in property. Potential for steady income and appreciation, but requires significant capital and management. It's like owning a rental property. It can be lucrative, but it's also a lot of work. Cryptocurrencies, digital or virtual currencies. High potential returns with extremely high risk. Think of it as digital gold mining. It can make you rich or leave you with nothing but a broken pickaxe. Behavioral finance, the psychology of investing. Investing isn't just about numbers and charts, it's also about psychology. Our brains are wired in ways that can lead to irrational decisions. Understanding these tendencies can help you become a better investor. Common psychological biases. Overconfidence. Believing you know more than you do. This can lead to taking excessive risks. It's like thinking you're a professional chef after making one good omelet. Loss aversion. The pain of losing money is twice as powerful as the pleasure of gaining it. This can cause investors to sell winners too early and hold on to losers too long. Herd mentality. Following the crowd without independent analysis. Remember the dot-com bubble? It's like everyone rushing to buy toilet paper at the first sign of a pandemic. Confirmation bias. Seeking out information that confirms your existing beliefs. It's like only watching news channels that align with your political views. Anchoring. Relying too heavily on the first piece of information encountered. For example, if you buy a stock at $100, you might irrationally hold on to it because that price becomes your anchor, even if all signs point to sell. How to counteract these biases. Stay informed. Educate yourself continually. Knowledge is power. Set realistic goals. Understand your financial goals and risk tolerance. Create a plan. Have a solid investment strategy and stick to it. Review regularly. Regularly review your portfolio and adjust as needed. Seek professional advice. Consider working with a financial advisor to stay on track. Risk management strategies. Risk management is about taking steps to minimize potential losses. Here are some strategies to help you manage risk effectively. Diversification. As discussed, spreading your investments across different assets to reduce risk. Asset allocation. Dividing your investments among different asset categories based on your risk tolerance and investment goals. It's like balancing your diet with proteins, carbs, and fats. Hedging. Using financial instruments like options and futures to offset potential losses. It's like buying insurance for your portfolio. Stop loss orders. Setting predetermined sell points to limit losses. Imagine having an automatic eject button that gets you out of a free-falling roller coaster. Rebalancing. Regularly adjusting your portfolio to maintain your desired level of risk. It's like tuning up your car to keep it running smoothly. Case studies of risk and reward. Let's look at some real-life examples to illustrate the concepts of risk and reward. Apple Inc. Investing in Apple in the early 2000s was high risk, but those who believed in the company's vision were rewarded with astronomical returns. The dot-com bubble. In the late 1990s, many investors jumped on the internet stock bandwagon, only to see their investments plummet when the bubble burst. Bitcoin. Early adopters of Bitcoin took a massive risk on a new technology, and some were handsomely rewarded. However, the extreme volatility also led to significant losses for others. Real estate. Investing in real estate can provide steady rental income and capital appreciation, but the 2008 housing crisis highlighted the risks involved. Enron. A cautionary tale of a company that appeared solid but was built on fraudulent practices. Investors who didn't diversify were left with massive losses. Practical steps to start investing. Now that you understand the fundamentals of risk and reward, let's talk about how to get started with investing. Set clear goals. Define what you want to achieve with your investments: retirement, buying a house, funding education, etc. Understand your risk tolerance. Be honest about how much risk you're willing to take. Educate yourself. Read books, take courses, and stay informed about market trends. Start small. Begin with a small amount of money you can afford to lose. Gradually increase your investments as you gain confidence and experience. Choose the right accounts. Consider tax-advantaged accounts like IRAs and 401(k)s. Diversify. Spread your investments across different assets to reduce risk. Review regularly. Regularly review and adjust your portfolio to stay aligned with your goals. Stay calm. Markets fluctuate. Stay focused on your long-term goals and avoid making impulsive decisions based on short-term market movements. Conclusion: the thrill of the financial roller coaster. Investing is a thrilling journey filled with ups and downs. Understanding risk and reward is the key to navigating this roller coaster with confidence. By educating yourself, setting realistic goals, diversifying your portfolio, and managing your emotions, you can make informed decisions that balance risk and reward effectively. Remember, even the most seasoned investors experience losses. The goal isn't to avoid risk entirely, but to manage it wisely. So strap in, stay informed, and enjoy the ride. Your financial future awaits. FAQs. Answering your burning questions. Q. What is the safest investment? A. Typically, government bonds are considered among the safest investments, but they also offer lower returns. Q. Can I lose all my money in the stock market? Yes, if you invest in a single stock and the company goes bankrupt. Diversification can help mitigate this risk. How do I start investing with little money? Many online brokers offer low minimums and fractional shares, allowing you to start investing with as little as $5. What's the difference between a mutual fund and an ETF? A. Both offer diversification, but ETFs trade like stocks on an exchange, while mutual funds are bought and sold at the end of the trading day. How often should I review my portfolio? It's a good practice to review your portfolio at least once a year, or whenever there's a significant change in your financial situation or goals. By understanding the balance between risk and reward, you can make informed decisions that pave the way to financial success. So, take a deep breath, do your homework, and get ready to invest in your future.